This diagram compares the International Energy Agency's strict 90-day standard against China's estimated import cover, which fluctuates between 110 and 180 days. That surplus requires a sprawling physical footprint to hold roughly 1.2 to 1.47 billion barrels, dispersed across national, commercial, and mandated enterprise tanks. But the precision of these numbers is an illusion. Beijing does not publish official reserve data, leaving analysts to reconstruct these volumes entirely from satellite imagery and customs gaps. Placing these outside estimates next to the IEA benchmark suggests a direct comparison. In reality, the legal rules and mathematical inputs governing the two figures are entirely different. China holds a formidable buffer, but judging its security by the 90-day standard misleads market planners with a false equivalence. The 90-day rule was forged in the aftermath of historical supply shocks. It operates as a binding treaty obligation for OECD member nations. IEA members must maintain 90 days of net imports, submit audited reporting, and execute coordinated stock releases. China is an association country, not a full member. It shares market data that carries zero legal requirement to hold a specific reserve volume. When severe disruptions fracture global supply, China remains outside the emergency system. It has no obligation to join collective drawdowns. These stored barrels belong entirely to Beijing. The stockpile operates as an instrument of sovereign discretion, untethered from the multilateral predictability of the IEA framework. This schematic breaks down the mismatch. The IEA calculates its 90-day rule solely against audited net imports from the previous year. China imports massive volumes but re-exports refined product, yet its emergency stocks are frequently quoted against gross imports, completely ignoring re-exported barrels. Calculating days of cover against gross imports creates a massive denominator. The exact same volume of stored oil yields a much lower day count than if it were measured on a net basis. The timelines also clash. The IEA relies on stable, audited annual data, while China's live cover rises and falls sharply, driven by volatile buying sprees and sudden, unpredictable market pauses. Comparing a volatile gross import estimate to a fixed audited net import standard warps the data. The true gap in supply security cannot be quantified accurately on this single axis. For energy strategists and suppliers trying to forecast demand, this asymmetry demands a shift in analysis. You can confirm that China's unilateral buffer is deep enough to shield it from panic buying during short-term market shocks, but you cannot rely on China to mirror the IEA's response. Sudden shifts in Beijing stockpiling behavior inject unpredictable volatility directly into seaborne markets. Discard the 90-day comparison. Approach China's reserve as a deeply stocked, independent variable that operates entirely on its own terms.